The largest pools of money on the planet quietly changed how they invest. No headlines, no panic, no announcement that the old strategy had stopped working. But behind the scenes, institutions managing trillions began restructuring their portfolios for a different economic world. And most ordinary investors still haven't noticed. If you hold a traditional 60-40 portfolio, 60% stocks, 40% bonds, you're using a strategy built for conditions that may no longer exist. For decades, the formula worked because of one core relationship. When stocks fell, bonds usually rose. The bond allocation acted like a shock absorber, the airbag deployed during the crash. That became the foundation of modern investing. Retirement funds used it. Financial advisors recommended it. Entire generations were taught this was what a balanced portfolio looked like. And for nearly 40 years, it worked. But there was one hidden assumption underneath all of it: interest rates would keep falling. From the early 1980s through 2020, rates in the US declined almost continuously. Every major crisis followed the same pattern. The economy weakened, the Federal Reserve cut rates, bond prices rose, and portfolios recovered until 2022. Stocks fell, but bonds fell too. The S&P 500 dropped nearly 20%. Long-term bonds suffered some of their worst losses in decades. For many investors, the defensive half of their portfolio became a second source of damage. And that moment mattered for a much bigger reason than one bad year. It exposed something most investors never realized. The classic 60-40 portfolio was built for a low inflation world because inflation changes the rules. When inflation surged after 2021, central banks couldn't immediately cut rates to rescue markets. Doing so risked making inflation even worse. So instead of cushioning the fall, bonds declined alongside equities. Diversification stopped diversifying. And while retail investors debated whether this was temporary, large institutions were already repositioning. Quietly, Yale's endowment dramatically reduced bond exposure over the past 2 decades while increasing allocations to real assets. The Norway Sovereign Wealth Fund also reduced its bond allocation over time. Pension funds globally increased exposure to infrastructure, commodities, energy, and real estate. Not because these assets are exciting, because they behave differently when inflation changes the environment. That's the key idea most people miss. The institutions weren't abandoning diversification, they were redefining it. In the old world, bonds were the primary hedge. In the new world, institutions started asking a different question: what protects purchasing power if inflation stays structurally higher for longer than expected? That question changes portfolio construction completely because some assets suffer from inflation, others adapt to it. Energy prices rise, infrastructure assets can increase pricing, real estate rents adjust upward, commodity exposure often benefits directly from supply shocks and currency weakness. In other words, some assets get hurt by inflation. Others transfer inflation into revenue, and that distinction is now shaping how institutional money moves. The modern institutional style portfolio often looks more like this. Equities remain the growth engine. Bond allocations shrink and move shorter term, reducing sensitivity to rising rates. And more capital moves into real assets, REITs, infrastructure, commodities, energy, industrial materials. Not because they always outperform, but because they respond differently when the economic regime changes. And that phrase matters: economic regime. Large institutions don't just think about markets, they think about environments: low inflation, high inflation, falling rates, rising rates, cheap energy, expensive energy. Different environments reward different portfolio structures. The danger is assuming the conditions that built the last 40 years will automatically define the next 40. Because history rarely works that way. Most people only recognize these shifts in hindsight, after purchasing power erodes, after portfolios underperform, after the old assumptions stop working. By then, The transition is already complete. The people who preserve wealth long term usually aren't the people chasing the highest returns. They're the people who recognize when the environment itself has changed and adjust before everyone else is forced to. The biggest risk in investing may not be volatility, it may be assuming the system that built the last generation of wealth will build the next one too. Subscribe to Wealth Velocity for more breakdowns on the structural shift shaping money, markets, and wealth. We'll see you in the next one. This video is for educational purposes only and does not constitute financial or investment advice. All figures and examples shown are for educational illustration only. Past performance does not guarantee future results. Individual results will vary based on personal circumstances. Nothing in this video should be construed as a recommendation to buy or sell any specific security, fund, or financial product. Always conduct your own research and consult a qualified financial professional before making any financial decision.